Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Welcome to the show.
Owen, thank you.
Yeah, it's going to be a good chat. We're talking ETFs, we're talking disruption, we're talking technology, all different types of stuff. But you haven't been on the show before. So what I might do is I might start with some icebreakers. Yep. We first met a little while back. We went to lunch at Lucy Lou in Melbourne. So here we're in Sydney. So I'm in your hometown. What's the best restaurant in Sydney?
Oh, look, I'd love to be able to tell you. And for those Sydney siders, it's probably quite patriotic. You know, I live in the north. People live in the east. We don't get to cross pollinate much.
Okay.
Look, I've got two young kids, and like the ability to go to a restaurant is essentially zero. So it's funny because my oldest daughter is 7, and her birthday was sort of around August, and I said, "Okay, well, you can go anywhere you want." As a kid, I don't know exactly what she's going to say, and her answer was the pub. So I don't know what that means for what I've done to my children. So anyway, like I live in Manly, so we went down to, if you want a particular name, I went down to there's a pub on the beach called the Stain, which people from the northern beaches would know pretty well. Yeah. So that's my one tip if you've got kids.
Okay.
Who love chips.
Yeah. Okay, I like it. All right, here's a more technical question, but and we could go on about this for forever, but it is an icebreaker, so I will add that disclaimer in there. What percentage of Australian investors' portfolios will be invested in ETFs by 2030 versus should be invested in ETFs by 2030?
So I think for my sins, I was an advisor for a long time before moving into ETFs. And I think it's always got to be careful because every investor is different.
Yeah.
You've got investors who are retirees, who their portfolios look very different than someone who's coming into the game as a younger investor. But I think if you take it from the perspective of you can build a portfolio with ETFs only, still be diversified, have a nice asset allocation program, whether it's in your super fund, whether it's personally. If you take a bit of lead off the US, and I just actually saw a stat this morning, they're using ETFs from a portfolio perspective around sort of 60%. The trading in ETFs in the US now is again, this is not a perfect number. This is based on one day, but you can circa 20 to 25% a day in terms of volumes. You compare that to Australia, it's 5%. So you've got, I think to answer the question, if we've got 7 years to go, I would suspect to see that trading possibly double. And then on the back of that, you would suspect to see, holdings to double, and with the hope that they're long-term holdings. So that's what ETFs are really built around.
Yeah, we're just talking off here about how some ETFs are used for trading, but for the most part, long-term investing. Okay, final icebreaker, mate, which is a bit of an interesting one. I've never asked this on the program before, so you're the first. If you could have one learned skill or talent or ability, like something realistic, so not like you're invisible or something like that, but something like I don't know if you have a hobby that you could then improve on, what would it be?
I think this is pretty specific. Again, we just mentioned I've got a couple of kids, and when you work in the city, it's got a lot better getting home with the traffic these days. But my wife would definitely say, if I could do dinner more, and what I mean by that, so let me clarify. I have zero creativity when it comes to cooking. So I can tell you, again, from my former life as an advisor working in ETFs, he's had to build a portfolio. He's had to put those ingredients together to have something that works. No hope when it comes to cooking. Like if you gave me 5 ingredients to go make something, it's just not going to work. So I wish I was much better at that, as does my whole family.
Well, it's you and me both, mate. I always think if there's like a steak, I'm like, I've got to eat the steak. It's got to be cooked. So what's the quickest time I can get it from here to there? And unfortunately, that doesn't really work.
No. I like your efficiency model, though. It's a good one as well. And that's how I certainly play it out.
Yeah. It's different when you have kids too. So, mate, GlobalX, bought ETF securities. It's like kind of like this global business that's now arriving here in Australia, and it's coming in a big way. You've been with the business for quite a few months now. What does your role entail exactly? Like for people that are new to what you're doing, it's head of investment strategy, right?
Yeah. So I think for very quickly before we dive into that, I think just from the explanation of what Global X is. So yes, we have essentially merged the ETF securities business, rebranded it to Global X. So Global X is essentially a US-based business. It's, globally they've got offices across the world, to London, Sao Paulo, obviously now Australia, which is great. Mm-hmm. Circa around 60 billion Australian dollars in terms of assets under management. Now that's not going to even compare to the BlackRocks of the world or the Vanguards, but we are a bit more specific around what we're doing. We're not trying to compete with those type of ETF players. 'Cause, we know what they do and they do it really well. So where we are, where we think we do really well, where we think we provide the best solutions, is probably more what we're probably going to talk about today is the thematic space.
Yep.
That's something that we're really strong on. What we also do a lot of is commodities. So ETF securities, obviously very well known for gold. That's now the Global X Gold ETF. And we're going to build that out. We want to give people choice around commodities, because really, what's the best way for an investor to play, if you're not an institutional investor, to play commodities? It is likely through an ETF.
Yeah.
And whether that's sort of an equity, commodity built by the miners or on the physical, there's a couple of ways to do that. I think the third one, and this is certainly because we know Australians, super funds, is probably income. So giving income choices to investors. So we're going to have sort of those three pillars.
Yep.
What does my role entail as head of investment strategy? It's really trying to bring to life the research that we're generating, certainly out of the US, and give it to investors to make it relatable, make it digestible. So let me give you an example of that. I think, we've got a sort of 30-person circa research team in the US with a heavy focus on thematics. So what you get from, whether it's the BlackRock, again, the iShares or the Vanguards, they do really, really good research, but it probably is more at that macro level. They provide you with some asset allocation views. They'll give you some content that is certainly relevant and important, but they're probably not playing in the space of that bottom-up research on a particular thematic. It's not necessarily that anyway. So what we do is we want to make sure that research is deep, because investors like that you talk to all the time probably have multiple sources, whether it's a podcast, whatever it may be, that we want to just bring that to life. So part of the job that I'm entailed to do and tasked to do is to help translate that research. It is essentially institutional quality, like bring that down and make it relevant for Australian investors, whether that's across the whole range of thematics that we can play into. So it might, if it is a space, and we can talk about this later if you want, like electric vehicles, mobility, the future of that. We know lithium's really big in Australia. We've got some miners that have played out here. So people sort of are across that compared to, say, the US, where they're maybe not across that part of the world, but they are much more across the electric vehicle space. So that whole supply chain is, how do we bring that together to make it really relevant?
And that's an exciting role for you too, because you've got that research backing. You've got the team in Australia that executes on it. And then you get to sit kind of like as the linchpin between them and articulate that and bring that, as you said, like bring this. This is what we're talking about today. We're talking about like disruption today, right? And you get to bring that to the forum like this, and it's really exciting. So let's dive into that. A lot of people, like I get heaps of questions from the RAS community, from everywhere that I go. People are like, what do you think of this? Like there are like beta, there's like beta that you can buy for basically free these days, right? It's so cheap. But then when it comes to thematic ETFs, that's where people are genuinely curious about things. They're like, well, lithium, gold, whatever the case may be, maybe not gold's not so much a thematic ETF, but they think, this is exciting, this is interesting, and I have a view on this. But then you, sitting behind the scenes, you're the one that has to create this and bring this to the market, right? So I guess the question is, how do people on the investor side of the table relate to you designing these things? Like, how do you make sure that what you're building is a legitimate theme that should be exploited versus something that's like, something that's just going to be a fad or just fade away?
I think it's a really valid question. And I think the way that we do it, and I'll walk you through, it's obviously a process.
Yep.
I think stacks up from the investor side as their own process to do their own due diligence when it comes to how they think they should invest in a certain thematic or anything really. Because I think when you think about thematics, you're not necessarily buying an off-the-shelf index. So again, if you want to have an ASX 200 index or an S&P 500, they're already established. They've been built for many years. So if you're an ETF business, what you're going to do is you're going to go, we just want to license that particular index. We'll bring that, indexes aren't investable, but ETFs are. So here's the ability to invest through that index. Again, valid, really important to have as part of portfolios. With thematic, so it's a whole different ball game. In that, what we do is essentially we're building the research and understanding a couple of things. What are true thematics and what clients need and what they want. So investors, advisors, institutions, whoever may that, and then working to bring those type of thematics to life, again, in an investable process. Because what you're going to get as a discrepancy between a thematic and a broad-based index is much more around things like revenue purity. And, it's pretty obvious what I mean by that is you want to be, if you're buying a thematic that is, again, we'll use the same sort of examples before around, electric vehicles. If you're going to do that, you want to know that what your exposure is not so broad that you're getting things that maybe just touch the electric vehicles on the side, but are going to skew what your return looks like because they're not really exposed to it. So what that example might be, if you're in electric vehicles, there's cases where something like Apple might be in the index because they obviously have potential with CarPlay. They might have potential with, what they're doing in their own electric vehicle space. But again, what's their revenue look like from a perspective potential of that? So I think there's that. So let me go back to the points of how we think about it. So one, we have to be, and again, investors should take this on board themselves around how they should think. Not advice per se, but it's more a framework. Got to be high conviction. So we need to be highly convicted that this is an actual proper theme. And when we break down themes, so under this sort of first point, we've got sort of three buckets. We've got the first bucket being disruptive technology. So this is something we can discuss.
Yep.
The second one is the changing dynamics of people and geographies and those sort of areas, which we can, which might be e-commerce, something along those lines. And the third one is the physical environment. So that might sort of encapsulate climate change. So this is the three buckets.
Yep. From
those three buckets, they're not really investable. They're too broad. You want to go down the next layer under those buckets, and that'll give you the theme that you want to play into. So if it is disruptive technology, it might be electric vehicles as an example. If it's people and demographics, as the changes, an interesting one we have in the States is a cannabis ETF. Now, we debated a long time if that's the right thing to do. Is it right, especially for a brand? We need to take this stuff very seriously. That legalization process that's happening globally gives you much more confidence in that. And we just saw, I think it was last week, when Biden basically pardoned everyone on marijuana convictions in the States. This is the shift, and that's not in the case in Australia. So, but that's an area that's moving. That's where the trend and the theme is happening. And then I think in the third bucket, which is physical environment, again, we can discuss this, is that sort of change around renewable energy. It's the change on infrastructure and what's happening in that space. So again, these need to be that's that third bucket. So we're going to be high convicted what that is. The second one, I think this is really important. I think many of your listeners would know this already, but it has to actually be investable. Like, you've got to be able to actually buy a broad range of publicly listed companies that give you, as I mentioned earlier, like proper revenue exposure to this particular thematic. And the important part here, I think, is, and we've seen a little bit of history of this, and you're probably well aware, that you don't want to be in companies that are too small, or in terms of their market caps are too small, because if your ETF happens to catch on and people really like it, and what that thematic is relevant, you have the ability to have that flow-on effect and move the underlying price of that particular company. So you might have known a couple of years ago, out of the US, there was a clean energy ETF.
Yep.
And it essentially got so big and the flows got so strong that it started to have flow-on effects and move the underlying securities, which then obviously has a flow-on effect because it moves the ETF. And that's great on the upside, but when it all came crashing down, it's a spiral effect. So you don't ever want to be in a position where what you're doing is creating more pain or more accentuating, what the ETF is doing. So you basically want to institute sort of restrictions on those sort of really, really, really small companies in that space. Even though they might be really revenue pure, that's all they might do, but you don't want to go too deep. And then the last one is sort of the time frame. These have to be long-term thematics. They have to, to your point on the fad, you just can't be throwing that stuff and going hoping for the best. And whilst they might be to a certain degree tradable, that's not what they're here for. They are long-term. So they are around longevity, buying them now, evergreen. I prefer them to be evergreen. Are they going to continue to move? What we talk a lot about here, I'm sort of laboring this point. I'm doing it on purpose, but is the S-curve. So you probably know the S-curve around technology adoption. So every part of that technology and S-curve, and we've got some of this stuff through our website and some of the presentations we do, is where particular thematics will sit along that S-curve. So what that will show you is if hydrogen is really at the start of that S-curve, especially green hydrogen, well, there's going to be more risk return as your profile happens. But as adoption kicks in, that's when growth kicks in, that's when revenue more kicks in. So again, as you start to build portfolios, you start to look at those timeframes and how that works for what you think is the right thing. So anyway, go back to the point. Those are the three sort of things we think before we put an ETF out. And I'm happy to hear your thoughts, but I think that's kind of relevant for an investor to think about, is that right for me to put in a portfolio as well?
Yeah. I don't think I've seen the research on the S-curve with the thematic overall. I don't think many, I think conceptually we kind of think that as investors, we're like lithium, or maybe let's take green hydrogen. People kind of get the sense that this is early.
Yeah.
Right. Whereas like if it's e-commerce, that's further down the path. Like these are profitable businesses.
Exactly.
Right. Yeah. But that's really interesting that you kind of like map them along that journey, which is a really good framework. As you said, like the risk reward outcomes or probabilities will shift through time. That's pretty cool. And you've got I only found this because we were going to talk about this today, an annual like slide deck that just covers all of these in great detail. I'm looking at one here from last year or this year. It's 123 pages of this research. So there's a lot that goes into it, but you can see there, I think that's a really neat way to think about it, like under the high conviction, how you have those three buckets.
Yeah.
The liquidity thing, I think I did read of that before. How do you control the liquidity risk? Like say if it's like in the underlying and there are small companies, are there ways that you can protect investors by, I don't know, say like you having the index and someone else not having it?
This is we get a little bit technical here around the construction of how index providers work with ETF providers, and that's certainly there's lots of partnerships that go on there. What you'll find though is, and I think there's a bit of a learned experience because you look at the BlackRock and again the Vanguards, they're so big now in terms of there's been so much research about active versus passive, and some of the proponents of active obviously like to point to passive and say
this is exactly the point. Yeah,
this is actually going to create a problem. If everyone wants to exit, you've got a small door. But I think the evidence of that probably doesn't stack up, certainly in the broad-based indexes, because we've had COVID. We had massive problems with the fixed income and credit markets. Didn't really cause a huge run on to the follow through of that, and equity markets they were they were down at some. If we can remember, if you want to remember, it's not going to be fun, but 6 or 7% at the time. And again, it didn't have that sort of flow effect because the market's deep enough. Where the markets aren't deep enough, Owen, is in those smaller companies. So what you might want to do as part of the index construction, and we as ETF providers will work with index providers on this because, we're the proponents of this post going sort of live, is saying, okay, well, what we're going to do is we're going to cap to the market cap, the size of the company, how big the company is, so the market capitalization at 200 million. Or it has to have, we use an acronym called ADV, so average daily volume, above a certain number. There's no magic number for any of this stuff, but above a certain number. And a couple of those points combined, what that will do is it will give you the comfort that you're never going to fall into that bucket of buying these really small companies that then spike with an ETF coming online and everyone buying it, or they'll dip in something that's the same way. And I think that's what happened with the clean energy one. It did have some rules around that, so don't get me wrong, it did have some rules, but maybe they were just a little bit, they just needed to be tweaked a bit, and they did do that. So I think that was an S&P index. They came out and they tweaked those rules to fix those problems to make sure that wouldn't happen again. So I think investors. This is a broad-based comment, so I take it with a grain of salt, but I think they can have some level of comfort with reputable ETF providers that they are thinking like that. Going forward.
Yeah, I think so too. Large ETF providers, at least here in Australia, are extremely well regulated. Like we were just talking before about the process of like the legal and regulatory process of getting something to market is, it seems more complex than ever, but it's important. The thing that I always, I have some gripes with some ETFs. I got to be honest with you, but there are some ETFs that come to market. I just look at them like, and you can know probably what I'm talking about. And from an investor's perspective, you're like, okay, yeah, great. You get lots of questions on these, but as the expert in this space, how do investors? So you went through like what you think about, but how would an investor actually think about? All right, there's a bunch of these different thematics I want to get exposure to, but which one is like the best expression of that for me, and is this the right way to play? Like, is there like a checklist or something you can think about that kind of like guides people through this?
Yeah, look, I think, again, I put my advisor hat on and think about the work that you have to do. I think no one should shy away. And look, anyone listening to this podcast is not shying away from having to do research and work around what's right for them as a portfolio. I don't think there's any, again, going back to, there's no magic formula that you put these things in and out pops the best ETF, and that's not going to work that way, because every ETF is going to be different for you. You're going to have a different viewpoint around that. So I'll give you a real life example. My wife works for a small fashion label in e-commerce. So I get a bit of an insight into that space. And does that make me better or worse in terms of being biased towards e-commerce or not, or see something? She might use a particular company like Shopify. That'll be in an e-commerce ETF, obviously. But does that make me biased because now I think that I know all this stuff about, which I don't, obviously. I know nothing. It's much more confusing than what we're doing here. Or does it then, and then I'd say, oh, well, we've already got exposure to that, where it may be. But I think what it comes down to, and this is any investment, I think ETF particularly, it is that due diligence. So look under the hood. What am I actually getting? Because the good thing about ETFs, and I think many of your listeners would know this, is that it's transparent. That's the key. That's the key thing. It's giving you access to things you normally wouldn't buy. So international access to, again, if we're going to use e-commerce and Shopify as an example, you're probably not going to go and buy that individually yourself. So it gives you exposure to that by utilizing it through Australia. But you need to know, if you underneath the hood, that and I don't expect investors to look underneath the hood of an ETF and all these companies and go, do I need to go and do research on these companies? No, you don't. That's going to be too much. There's a level of trust in that theme. But partly what we're trying to do, and going back to the earlier point, is help around bringing research to and try to not be overly biased in one direction, because that's not research. That's just propaganda. But bringing content and insights and research that says, hey, you obviously have some interest in this because you're reading it. By you reading this is going to give you some sort of insight around, is this right for me? So I think doing that. I think we'll probably take a step back as well. Like, let's think about ETFs in general as a process to look at. I'm assuming you would have done this many times in the past around ETF selection. I know it's kind of your sweet spot. But there's so many things that you need to think about. And, if you use a checklist, I think I did read that book, that Checklist Manifesto, many years ago. I think it generally works. Certainly more in that mentality. It was about in surgery in a hospital, but we can do it. We can do it here. So I think looking underneath the hood, so doing the DD is obviously number one. That's if you do that and you start to get away from you, and that's not what you want to do, then you can walk away, I think, and say that's not the right investment for me. Then my investment might go up, but it's just not the right investment for you. Then I think it's sort of understanding the structure as well to a certain degree. I think in Australia now, we do have quite a few different structures in place. So you've got a situation of, and we mentioned it earlier a little bit, that active-passive debate of, and we know now that there's quite a lot of active ETFs in the market. You've also got listed investment companies. They have different benefits and issues. On both sides, so I'm not leaning either way. So again, what the best structure to invest through that might be. That's one thing. Again, if active or passive is the best way. If you have a true belief that in that certain space that you don't want to have any level of expertise and you'd rather a trusted investment professional to pick the stocks, again, that's where active works. You're going to probably pay more.
For sure.
That's the sort of space. So, but then you've got commodities. Obviously, we mentioned gold before. That's such a key part of what we do. The difference between a commodity and an equities-based version that mines commodities.
Really important. I get that question all the time.
And it's very valid because you're going to get different risks, but you're going to get different upsides. So if you're buying gold in GOLD, for example, you're getting access to the physical bullion. You know what it is. It's stored in a vault. If you're buying gold miners, what you're going to get is you might get the CEO leaving one day, but you also might get an exploration that pops up. And so you're going to get this, again, risks and benefits. What's the good and bad parts of all those sort of things. And then I think this comes back to the inherent underlying of ETFs, again, kind of compared to listed investment companies, but it's the tracking across, is the ETF that you're buying actually doing what you thought it was going to do?
Yeah, for sure.
Because I think what happens a lot of the time is you buy something and then you look at it and you just trust that hopefully it is. But especially in a portfolio, it's hard to sort of start to discern. I think actually we're getting a little off topic here, but for many sort of retail investors, it is somewhat, if you've got a portfolio, it's somewhat hard to compare that to what benchmark. What are you comparing it to? Have you done well? To what?
Yeah.
I think the second part of that point is have you done well compared to what your strategy you put in place at the start of what you're doing now? What I found back in my old days of advising is that a lot of investors actually don't have a strategy. What they do is they just continually buy and add on. So you're layering, incrementally layering. And I think it happens a little bit with thematics as well, because what you'll do is you'll have a portfolio, something will catch your interest around thematics, and you go, I want to add that in. But that's great, but has it got overlap with other parts of your portfolio? Is it actually not giving you any upside potential? And I think my point here is some of the tools that are available for investors aren't that great in this space. A lot of the online brokers probably don't provide. Some of them do a little bit of health check stuff and they have ETF screeners or those sorts of things. But,
it is hard to get that information.
It's really hard. Yeah. So what would be great, and some Excel whiz I'm sure has done this already, is you break out all the underlying holdings and have a look at overlaps across all your portfolio. Those sorts of things would be awesome. I'm not providing a solution here. I'm providing a problem. So don't get me wrong. But I think, and then so going back to the point, doing all that work, which is probably too much for a lot of people, but I think going back, hold the ETF provider accountable, because when you're tracking an index and it's a really large fund like SP 200, ASX 200, S&P 500, it's not easy, but it's the companies are doing that have a pretty good grasp on that, and you should get really close. It should be really, really close. It should be basically bang on minus the fee you're paying, and the fees are quite low in that space. What you're going to get with thematic is you're probably getting a little bit different, because you probably are going to get pretty close from a tracking difference point of view between the underlying index of that particular ETF and the thematic. Okay, so if you're investing in gold, the tracking difference is going to be really close. If you're investing in AC/DC with, say, lithium battery tech, I think the tracking difference is also going to be pretty close. But what's the tracking that is compared to a broader market index? That's what you're going to have to have a look at. I think that's an important thing to know, because what you're taking on when you're investing in thematics is inherently either more risk, because the upside is, the potential is probably greater. Return, and then the risk is obviously downside potentially greater, because you've got a narrower focus. Inherently, if you've got a narrower focus through one theme, the likelihood is that you're getting more risk around that. So I think it just I've kind of gone off topic a little bit there and sort of come back to it. But I think just from a listener's point of view, that's the kind of program I would think about as doing the work to get to that level of, okay, I'm comfortable with this, and because the important part is you're going to be holding this for long term. I would suspect they are.
Yeah, and you don't want to get it wrong up front, right?
Exactly, right? So this is your chance. Yeah. This is your chance to get it right. And I think a lot of the ETF providers do provide a lot of good information on their websites around this. And I think, again, going back to that research point, hopefully we can even give you more level of detail, that one layer down, to say, yeah, that's right for me or that's wrong for me.
Yeah. I still end up going like time and again to the ETF provider's website, like one by one, to check holdings. And I like to, like, obviously I'm the kind of guy that gets in the weeds a bit, but and there are tools like Morningstar provides a tool, which I think you may have to pay to get access to. It's not too bad. But at the same time, like a lot of people, at least in that kind of like the self-directed space, need to be consciously making that choice. It's not just like, I get a lot of people like, well, I've got this ETF, and they're just layering it on top.
Yeah.
I like to think of it as a collector. It's like someone who just buys and never sells, or like doesn't actually think. They just kind of store it all, and you end up with so much overweight and underweight in certain things you never even thought. But the big one for me in thematics is actually the tracking area. And it's not so much with equities, because that's, like you said, it's kind of a well-worn path, but it's more like when there's derivatives involved.
Yeah.
Like you start to get this kind of weird outcome, and people think like they're trading some sort of futures contract, and it's like, you look over a year, maybe they're not designed for that, but it's a little bit of a different outcome. And so I think this is a really good list of things, together with the info that you got on the site. There is, I guess, the one thing that I really wanted to get to with you, mate, is diving into some themes, and just, I guess, walking through them if we can, like stepping through them and just how you think about breaking them down, whether through those buckets.
Yep.
What you're excited about. Like in the US, Global X has a huge range of thematic ETFs.
Yeah.
I don't know if there's three that you're kind of interested in or that have been well established and are exciting. I think our listeners will get a lot of value from that.
Yeah, I think it's a good point. We were actually having a conversation with the research team last week around, and we were sort of talking them through what we want to do from an Australian perspective. We want to bring those sort of we've got a really ambitious product pipeline, because we want to make sure the Australian investors are serviced as well as the US ones are. And we're sort of talking to them about the research, and they made a really strong point. I think this sort of leverages on what we're going to say. They're like, research has nothing to do with products. The research is so independent.
Yeah, right.
We're agnostic to product. We want to provide research that is, best in class, and it's not like, obviously they're doing it because they want to support the business, and it's their intent is to, we're a fund manager, we want to sell products. I get that, but it was really nice to see how hard that Chinese wall was up. It was very strong. So I think hopefully we can elevate that down here. So anyway, that was just one point.
Yeah.
I think
That's fair enough. Yeah, I didn't realize that.
I think I think we'll take it from a little bit of a lens of what we hear most from investors, and this might be good or bad, because you might have already done this 1,000 times before, but I think it's still relevant to revisit this, because maybe there's one soundbite or one insight that we can sort of bring to light that an investor goes, that's a good point. And they might already be a holder. They might be thinking about what they want to do.
Sure.
So I think, first of all, I think, and we have been talking to a lot of investors and advisors about this over the last couple of months post the rebrand. One would be robotics and AI, and I think the reason this is exciting, I think the reason that we'll do three, but I think the reason them all, because the question is, as we are now with the market, is this an opportunity to buy? And I'm certainly not giving any advice. I'm just going to sort of frame it as that, because you've got a situation where some of these thematics are depressed. It's inevitable, and especially the technology. So if we stick with the technology theme, safely these strategies, I think a lot of them are very, very depressed in terms of their valuations. Obviously, that inherently puts pressure on their prices. So what these names were, I'm sure you read with all these growth names.
Yeah.
Have they now fallen into value stocks? Like this is what it's basically come to. Yeah, so if we stick to robotics and AI, I think we've had some really good insights around. So one of the partners we work with the ETF is a company called Robo Global out of the States, and they went to a recent show. I think it was in Detroit, and we're talking to a lot of these robotic companies. And if you take a step back on robotic companies, there's some big buckets, but there's those sort of ones that sort of build industrial robots. I can give you some examples of the stocks if you like.
Sure.
Surgical is another one. It's a really growing space. agricultural, think about John Deere. They were an industrial business for many years, and now they're kind of quasi AI business because that's what they're thinking. Yeah. But what the elements came out of that show that they went to, and some of the insights were order books for robotic businesses are as strong as they've ever been. They're over 12 months long, and part of that is we're in an environment now of inflation. If you're not in inflation, if you don't understand what's going on in inflation, I think you'd be hiding on a rock. You wouldn't be listening to this. It just wouldn't happen. And what comes generally with inflation is sort of wage growth. And we did some research on the wage growth through China, which is hugely, like, in terms of, if you went sort of back sort of circa 15 years, you're talking about something in the vicinity of 400% of wage growth. Whereas if you went to the US, it's still sort of circa 50%, which is a lot. It's a lot, but then robotics, especially industrial robotics, the prices have gone down. So if you're in an inflation environment, wages are going up. If you're a business, now not a car manufacturer, they've been doing this for years. That we'd all seen the videos of them with the amazing robots building cars. There is a bunch of spaces in the industrial world that hasn't moved there yet, and they are getting there. This is where these order books are. And the ability for these robotic companies to pass through the prices, I think that's the important part. So when you got inflation, you got material inflation, commodities have come off, thankfully. So that's obviously the inputs, but or wage inflation. If that can go through to the end consumer, which obviously then creates more inflation because it passes all the way through. But robotics is essentially built to be deflationary. Because if you think about what they're doing, is they're creating efficiency and productivity by either being better at what they happen if it rather than human, or creating less errors. So I think the upside of that is significant. We see that that would probably, this whole space is probably likely again to double in the next sort of circa 7 years. I think a couple of names. If I know investors like to know sort of some names in this space. There's one that's really interesting out of Japan called Fanuc.
Okay.
Yeah, so I think again, go have a look at some of. I'll tell you two names. So there's Fanuc in the industrial space, another one called Intuitive in the sort of surgical robotic space.
Yeah.
If don't pause the podcast and go away, listen to the whole thing, come back, but go and watch this video on YouTube by Intuitive. And I'm jumping here. I'll talk to you about what Intuitive does, but they essentially build, surgical assisted robotics for operations.
Yeah.
And there's this one amazing video of the machine peeling a grape.
Yeah, I've seen that.
Have you seen that?
Yeah.
It's incredible. So, the good thing about many of these companies, you get to know, especially if they're US listed, you get to know what's happening all the time. So Surgical coming out with their numbers very soon in terms of what they're happening, but they've sold, I think, circa 7 million. They've done circa 7 million operations. There's sort of around 7,000 of these robots, and that's a huge investment for a hospital to do that. So whether you're investing, you're buying a robotic arm for your industrial business, or you're putting in any type of robot through medical cases, there's a lag there. It takes time to train people. You've got to get people across the line. So I guess this is also the thing. If these companies are getting depressed in price, know that these order books are still strong, and the lag of actually how this is going to keep through to their underlying revenues is going to take some time.
Yeah. So
I think that space is really interesting. As sort of one. I think the second might be, and I think you probably would have done this until you blew, but I think the future of mobility is so drastic as a theme that when you look at it on that S-curve, it really is. And let me just give you the buckets of that S-curve if you haven't looked it up. But it starts as innovators, early majority, late majority, and then it sort of gets into that sort of laggards. And we really see as this sort of this shift in mobility being that really early majority stage. Like this is not, it's so everywhere, and there's so many articles on it. There's so many bits and pieces on it. There's obviously, there's now a showroom for a new Spanish electric vehicle brand down here in Sydney, in the city. There used to be one in Martin Place for Tesla. We think it's everywhere, but it's still very early days. So I think when you think about that shift, I think the important part is, where do you want to play across the supply chain? So the supply chain is essentially, certainly doing this at a high level, the lithium mining, which we're very well aware of in Australia, the names you're probably also aware of, the Pilbara and the Min Resources and the Allkems. then you've got the manufacturers, which probably isn't. This is not the sweet spot of Australia. I know we're trying to think we can do that, but probably isn't the sweet spot of Australia. That's more the Chinese and to the Asian markets. And then you've got the electric vehicle space. So you've got this whole supply chain. So you can either play those supply chains individually, or you can go bucket them as the whole mobility, EV, battery tech kind of thematic. I think there's problems at all parts of that supply chain, and there's benefits. The good things about all parts of that supply chain. I think lithium-wise, and we've done a lot of work on this, the deficit from a supply and demand program that's happening is this: the deficit and the imbalance there is so significant that unless something happens in the very near future, that it's just going to be out of whack. And we all know how high lithium prices are. That's not a secret for anyone. Everyone's seen that. If you look at the commodities price chart year to date, everything's down, lithium's up.
Yeah, it's been the one.
It's been the one. And hopefully many of your investors have benefited from that. I think it's obviously been a great investment. But the demand coming from electric vehicles, if you think about what lithium was used from before, like if you had a battery in a phone, it's this big.
Yeah, it's
you
like
have
a
battery.
teaspoon.
Exactly. You have a battery in a car. It's we're talking about significant amount more. So the demand supply balance is out of whack. And if you're a lithium miner, doesn't take 5 minutes to get a mine off the ground. You need to do feasibility studies. You need to look at the price and to predict the price in 3 to 5 years when this thing's going to come online. So we're in a bit of a delay there. I think that's got a flow through effect for the next two parts of the supply chain. So battery manufacturers having to buy lithium at a much higher price. Thankfully, the technology in that space is getting much, much better. I'm sure you've probably done this in the past, like looked at that technology again out of China. You're seeing just like leaps and bounds in terms of battery prices coming down, even in the fact that the inputs are going up.
Yep.
And then I think the third bucket of that is the electric vehicles. I think the dominating part of that is just Tesla, and whether that's just Musk or not, but or out of China, BYD. But I think if you look at the traditional car manufacturers, they're all coming up the curve. And you talk about the BMWs, Daimlers and Mercedes, Renault.
Yeah.
I read a point on Ford the other day that obviously with the F-150 Lightning, they've raised prices twice in the last 3 months, and the delay or the wait list is still 3 years.
Wow.
So the demand is there, and the pass-through of these costs is seemingly getting absorbed. So that's basically an elastic market that gets absorbed because the demand is so strong. So I think, that is such an interesting space. And if you putting that in the context of the S-curve being such early days, you look around here, and I don't know about Melbourne, what Melbourne's like, but like there's not that many electric vehicles cruising around. Yeah. Infrastructure isn't great here, so there's a massive amount of spend that needs to be in that space. You go to California, different ball game. You go to Europe, it's a different ball game. So, I think we're probably a little bit sheltered. We're very well aware of the lithium side, but we're not as well aware of the move towards the actual vehicle side. So again, where you want to play that curve, I think is important. So I think that's a couple of ideas.
Yep.
I think the last one, and you can call this a thematic or you can call it what, but we'll stick with the I think the technology theme is semiconductors. And I think the interesting part of this space is, and the reason I brought this up today is on that point I made earlier around valuations.
Yeah.
Like, I'm sure anyone brings up a chart of some of the semiconductor companies. They are absolutely savage. They've been sold off so significantly. They make up around, it would have been more, but I think they make up around sort of circa 12% of the NASDAQ, for example. We know the NASDAQ's been sold off. So semiconductors having a rally is going to help the broader market. And they're a bit of a conduit to the tech space anyway. I think, with those valuations, there is still some bright spots in that space. So the names that your listeners would know, so the NVIDIAs, the Intels. I'm going to ask you a question. What do you think? What's the bigger company? Is it NVIDIA or Intel?
I'm going to say NVIDIA because it's done so well. But the stock that I just put up as you said that was TSMC.
Yes. Yes. And this is a supply chain process. Where you've got, so you're right, NVIDIA is bigger, but it's bigger by, I think, I don't know the exact number today, but it's circa sort of three times, which would, I think, blow a lot of people away because Intel is probably something that if you buy a new PC, it's the stickers on your the little thing of what you get, and they sort of talk to it a lot. I know. I thought it was interesting when I looked at it.
It's 284 billion for Nvidia and 100 billion for Intel.
Yeah, there's a massive difference.
Yeah, huge.
And that probably has a little bit of leverage into that old COVID space and the crypto mining and using and GPUs instead of CPUs. But I won't sort of go into that level of detail. But there is a move around that kind of difference in what parts of a computer are going to drive the performance going forward. So, again, supply chain. So you've got Intel, which do everything. They design and manufacture, and then I think they are getting into those graphic processing units, the GPUs. You've got NVIDIA, who designs but doesn't manufacture. And you've got TSMC, who is basically the manufacturer of the world. But the problem in this space is whether you use sort of barriers of entry or use moat as your mentality of thinking about it, the moat or barriers of entry in this space is unattainable. It's essentially done, because who's going to want to build, like TSMC, a $20 billion facility, and where are your customers going to come from when it's basically all these programs are set? Like, what's going to happen? Where's it going to come from? So, that is somewhat a monopoly market. So you've got a situation where you need to understand the underlying components of some of these. Again, if it's an ETF that you're looking to look at that industry, that's interesting. Again, componentry of that. So buying one particular company, this is going back to the diversification. We didn't actually talk about that around. Everyone knows about how ETFs work, but the diversification part. What parts of either talk about lithium, supply chain, or in a case of semiconductor, for example, where do you want to be involved? Do you want to buy one company and buy NVIDIA, or does Intel have a research? I certainly don't know. But, do you want to be across both parts of that industry? I think there is some bright spots sort of starting to show around, again, things like order books, across things like TSMC, that they're a really good sort of conduit for the market. I think I saw a stat they expect to have, I'm not sure if it was sales revenue, but something on the lines of up about 40%. So again, that's probably priced into the market, so nothing major, but the numbers are there. Yes, there has been PC slowdowns, these sorts of things, but the space of all this sort of disruptive technology, where it's moving, has been under so much pressure. This is I think the point of raising these three particular ideas, is that, without giving not advice, but the opportunities for investors who are looking long term may start to present themselves at some point. There may be downside, it might be more downside, not to say that, but the opportunities, again, for a long term investor, you can start to think about, is this somewhere I want to buy or play, or have something that's part of my portfolio?
The ACDC ETF. I was chatting to the team the other day about this, that it is really well, I guess, diversified through the supply chain and the kind of the value chain as well.
Yeah.
I guess if you think about that, how we're going to talk about the S-curve before, the future of mobility, where, like, I don't know if you've got those off the top of your head or not, but where do you think we are in that curve? Do you think it's still very early?
Yeah, so our research is that it's early, because, again, you're separating a few things here. Lithium's not a technology per se. It's obviously a mineral.
Yeah.
So it's not going to sit on an S-curve in all technicality, because, maybe the mining can get a bit better, but that's not the game changer. A miner might be able to reduce costs and then deliver better, but it's not a technology. So I think the technology parts of those two, of this whole value chain, would be the battery technology. So how lithium ion is produced, range, these sorts of things, charging. And then the EVs is how that input works together, the software that goes into place. So I think if you put those two buckets together, I'd say battery technology is still, probably in the innovator days. Electric vehicle, because it's still a car. Yeah. It's a car. It's got wheels. It's got a steering wheel. I think Teslas have steering wheels. I'm not sure what they've got in there. But they're probably a little bit further up the curve, but they're both very much in those early days. So whether it's early majority or an innovator stage, they're very much in those early days. Again, I think that doesn't feel very intuitive, because there's so much going on around them. But if you think about it in the concept of mobile phones or the internet, it's kind of that same, they don't have the network effect like the internet would have done, because doesn't make a difference, but it kind of does in its own way with charging stations. That's what charging stations are, or the infrastructure for that. So, I very much right on the border of that innovators side, which is really that really low point of the S-curve, and the early majority. Early days.
So like these three buckets, these three themes are pretty well established. Like we're talking about, just as a example, is like lithium as a investment theme or sector, or however you want to frame it. That's like been very, very popular in 2022. As you said, like it's the one commodity that's up and to the right, Now I'm going to ask you to stare into your crystal ball a little bit and ask you, obviously this is just like your calculated bets on like what's going to be interesting in 2023 to a lot of investors. But what do you see on the horizon as something that's emerging in the zeitgeist of the investors, but even just in like in just various industries, what keeps bubbling up?
Well, I think this is where you can start to think about the technological side. That's one side that, again, it depends on what your worldview is. Some of these robotics, AI, et cetera, they're going to keep getting little things pop up because, again, I think the early days, if you're looking at it as a media, as a source of information, consistently you're going to see innovation pop up and big innovation. Whereas if you're at the back end of that S curve, what you're not getting is major innovation. You're getting incremental innovation. So an iPhone, for example, I'm going to answer a question, I promise. I'm getting around to it. But the iPhone, it's incremental.
Yeah,
it's not innovating. So I think where the exciting things for 2023 are probably, I think certainly maybe not semiconductors. It's certainly much more incremental now. It's more a valuation play. But the other two are certainly still headline innovation in the innovation space. I think, and we can talk about this in greater detail if you want, but I think where the next sort of shift is, this is all encompassing across everywhere, is that sort of climate shift that we're seeing as well. That is without question, at the forefront of pretty much every investor, certainly younger investors, and it should be compared to, say, older investors. And I'm not saying that all older investors aren't concerned about that, but anecdotally you hear things that they're not as concerned. They're retired, they need money to survive, so it's more important on performance. But that I think is as a broad encompassing point, and the underlying of what that looks like is, just to say climate, that's a very broad brush stroke of what we're looking at. So you can really start to dig down, and not only what you can do as an individual, but how you can invest in that space. I think that's the interesting side, or for me anyway. Sure, you can have shorter showers, turn your lights off. That's all valid. But if you want to try to benefit and work in that world, well, I think there's certainly ways to do that still. And there's going to be more to come, I would suspect.
But how does that? So this is a really good, example or use case. Like, how do you then take? Because me and millions of other people around the world agree with you, right? Like that a focus on climate is important. And I'm increasingly hearing more fundies, more investors, more researchers talking about this is a problem, but you can make money from it. This can be a positive thing. It doesn't have to be like cost everyone everything. Through innovation, you can make money, right?
Yeah.
So how do you take that concept, right? And this is a kind of the thrust of this episode, this conversation is like, how do you take that and then put it into ETFs? Like, how do you make that available?
Yeah, and let's go back to that thematic point we made earlier, I think, and we can sort of draw this out a little bit. But I think it goes back to that mentality. It shouldn't be a negative to try to derive wealth out of a change or shift, or a paradigm shift that we're seeing, and climate is one of them. It's kind of like when Apple raises the price of its iPhone all the time and their margins go up. Well, why don't you buy some Apple stock and benefit from that as well? Like, that's the kind of thing. Play along with the game.
Yeah.
But I think there's a couple of ways you can play the climate change world, and I think what the big move that's happened over the last couple of years has obviously been ESG. So that's broader than just climate change. That's a specific sort of bucket. And what we've seen, certainly institutionally, is that if you're a super fund, it's definitely the case in Europe, or even in Australia, the expectations is you have really good understanding of what that means for the investment program that you have. So I've seen a lot of things with whether it's Aussie Super or all the big super funds we have here, they all have obviously an E or ethical option.
Yeah.
We have ethical only type of fund managers as well. So I think that's sort of one way that people can sort of get exposure or feel good about what their investment process is. And that's not really what your question is. but I think from an ETF, you can play it a couple of ways. One is you can do that ESG type mentality. So you can say, I'm going to do the negative screening. So, negative screening being, I'm going to take out companies that I don't like or associate with or don't want. It gets complicated pretty quickly because what is right for you might not be right for someone else. This is a very, very subjective space.
Yeah.
This is partly the problem, is where you've got S&P 500. That's not subjective. It's subjective as you can get. It's market. Well, it's actually slightly, but the index rules. But essentially, it's market cap.
Yep.
Biggest companies go to the top. With ESG and climate change and sustainability in general, I think it's just such a minefield for one, investors looking at what they want to buy, and two, for fund managers trying to bring the right product or the right solution to investors as well. So if you're using negative screens, what's right for me compared to what's right for you might be very different.
Yeah.
And then go back to your earlier question around ETFs, one might have, if you go and take out essentially everything, that's going to have a really large tracking error or difference compared to the underlying index. So I think when we think about how we would bring an ETF to life in this space, it has to be, I think, even more considered, because you need to sort of do those 3 steps with the high conviction, the investability, and the time frame, and then you need to start to take into consideration what truly is green. If it's going to be green, what is it? Is it light green, dark green? Like how dark you want to go? There is there's a spectrum here. So I'm not answering your question well, because I think the answer would take we'd be sitting here for the next 3 days. I think because there's so much to this. But I think essentially going back to the high level, you can buy ESG, so essentially screened versions, so things getting things taken out. You can buy positive screen now. There's not actually that many in Australia. There's more in Europe. Or the place that we're probably going to will likely play in is more in, here's a thematic that plays into that world that might, again, align with what your thinking is from a perspective of investability. So again, not either one of those is right for everyone, but that's kind of, I think, the way the world's going to start to go when it comes to that sort of broad brush stroke of climate.
I got an email this morning, it was an hour ago, just as literally you were walking into the office, an announcement like the green metals, green miners ETF.
Yeah.
Is that what it is?
Yep.
Yeah. Green metal miners ETF. So there, like, that's kind of like partly answered my question as well, right? Like there's an expression of this taking place. Yeah,
there's an expression of this. I think, you might look, we can discuss that. I think that's a good point. But whether it's what part of the transition around, that the biggest point that everyone sort of focuses on, especially in Australia with coal, we're coal exporters, we're coal users, is sort of energy use and that transition from traditional energy use to, what is renewables, whatever it may be. So whether that's hydrogen is certainly a space. It's, again, S-curve. Always think about the S-curve when it comes to thematics. Very early days. I think I mentioned that earlier. Or if you're talking about green metals, what does that even actually mean? Like, what's a green metal? Like, I think the concept is probably a little bit foreign to someone. So as a very brief explanation, these are metals or minerals that are going to play a role or play the role in moving from an old coal-fired power plant to renewable energy. So wind farms, so solar panels, these sorts of things. Infrastructure that drives the outcomes of that, charging stations. So what are the metals that are going to do that? It's not coal. I'll give you that tip. I'm pretty sure everyone would have figured that out pretty early on. But it's things like copper, things like aluminium, obviously lithium in batteries, zinc. So they're always going to have multiple use cases, traditional use cases, but they're also going to have new use cases, and that's the differentiation around where previously you were in terms of what we used to use metals for and what we're going to use metals for now.
I think that's the thing, right? People, I heard someone, I think it was yesterday, someone say to me, therefore, people driving around Teslas, they still need aluminium. You still need these other things, right? So there's more to it than just, screening out everything, every part of mining. I think that's something that a lot of people are waking up to. It's, hey, there's a lot more to it than just don't do this, don't do that. Like there's shades of grey in between all of that.
Well, we got to build like the infrastructure, and I'm personally not have any skill set. An engineer's got to build this infrastructure, and you got to. I think you can't really just have this blanket rule that all mining is bad, because that is part of the solution to moving to what we want to move to. I think like anecdotally, you start to bring it to life a little bit, you can sort of say, okay, I think copper's a good one, because copper traditionally being used in things like houses, certain telecommunications, these sorts of things, which certainly aren't necessarily built around a climate shift or a change or sustainable investing. But now what the shift is, I think the stats are, and don't quote me on this, even though you're potentially going to quote me on this, but is I think you need sort of circa, for a megawatt of output, you need circa 1 to 1.5 tons of copper in a traditional power plant. I think you need something in the vicinity of eight times that, or around eight tons of copper for a renewable space, more in the renewable space, like a turbine farm, something like that, a wind farm. So the need of something like copper, again, it's a traditional metal, but if you're going to think about where the input's going to be, it's going to go into building renewables. Again, another stat would be a traditional car might use circa 20 kilos of copper as part of it. It's obviously built with steel and aluminium. An electric vehicle uses somewhere between sort of 60 to 80 kilos of copper. So again, that's the shift around where it's moving. And this comes back to this point we made earlier around lithium. And lithium is part of it's definitely a green metal because it goes into electric vehicles. It's a battery program. So that's obviously key to a shift around to the green world. But is the supply and demand program and the imbalance that happens on the back of that. So copper's certainly been sold off. It's an economic indicator, essentially. How the world is going is going to be indicative of how copper's sort of moving. But if you look long term, that change is going to shift to not be necessarily all about that because of the use cases. I'm sort of honing on copper here, but I saw a stat from HP a little while ago. It said over the last 30 years of copper output, we're going to need double the amount for the next 30 years because of this transition to different energy sources and energy uses. And that, I think you can say the same across a huge range of these metals. Lithium's one we won't talk about anymore, but is the same. Aluminium's another one. You might have seen aluminium in particular has started to move higher. It gets produced a lot out of Russia. But the US administration is starting to think about, is that going to be the right thing? Are we going to ban? The next incremental stage on what they're banning out of Russia might be metals as well. So there is such a space where I think looking forward, making yourself feel good. If you are wanting to invest in particular commodities and you want to have that that bent towards climate or sustainability, this space might be relevant for someone like that.
We've covered a lot of ground, mate. We've covered basically how to think about like an ETF being manufactured, how to break apart an ETF if you're looking in a particular theme. You took us through robotics, future of mobility, and how that plays in like lithium batteries, all that sort of stuff, and semiconductors. And you've also told us that you've also given us a good pub recommendation, which I think I'll have to check out along the beach. But mate, if people wanted to find out, say like where the research goes and all of that, where can they head? Yeah,
so the GlobalX website is now, so obviously it used to be ETF Securities. Even if you type that in, obviously it'll revert. But so globalx.com.au. I think we've got about 15 pieces of insights on there at the moment. That's going to only increase. And we hope that we can bring things to life. Like, it's great sitting down with you, someone like you, Owen, because I think you help bring things to life in a nice way. Written word's great, but, talking to someone. So we want to make sure we produce videos for people who might want to digest it that way. We're probably not going to do our own podcast. That's more your space, and I'll leave it to you. But I think they can head there, and then by all means reach out. Let us know. Let us know what's going to be relevant, whether it's through someone like you or whether it's through the website or however, if we're at certain things that a retail investor might be at, grab us and tell us, because I think we're getting a lot out of the States. It might not be relevant for Australian investors. We want to make sure it's right. So we take this very seriously, and we want to make sure that everything we bring out is not just super American focused, which happens sometimes with some of these big American investment firms. Australians are slightly different.
Sure.
Fairly different around how they think. So we want to make sure that is the right content, insight, research for them.
Yeah, cool. I'll put all the link in the show notes. So if you are interested in the ETFs that we referenced to, check out the show notes. There'll be a link there. Blair, mate, it was a great interview. First good knock, mate. I really enjoyed it. So thanks for taking the time to join me.
Appreciate it.